thanks for having me. I told the guys earlier that I've not presented in the economics department in forever, so I apologize if my slides and my everything sort of gimmicky for you. Not that people in finance are not doing serious presentations, but there's a little bit of a different flow to the whole thing. So this is brand new work. I have never presented this. It's first presentation I do, so I'm very excited. I'm very keen to hear your feedback on this, in particular because some of the has a little bit of a theoretical derivation, and then looking at some numbers, and the numbers are pretty striking. So I'm wondering if I'm just got it wrong, or if everybody else, if there's something that you really found there that's interesting. So so this paper is about a very simple idea, trying to see if, trying to ask the question, there's a concept, new concept that emerged from decentralized finance, and hypothetically speaking, could we apply the tools that have been developed there to traditional markets, and if so, what would that be? So this is a little bit different maybe in some of the papers that you would see in the series where people, for instance, look at the DeFi blockchain crypto space, and if they look at data, they take data from that space. We're trying to ask more of a hypothetical and say, well, let's say if we use this somewhere in normal equity, what would that be? So just as to give you a brief overview of what I want to do, I saw that on the list, bear with me because I'm modified in the contract system. This is where I'm normally coming from. So that we can understand what the difference is. I'm also going to talk a little bit about the differences between centralized trading and decentralized trading. And so to meet that question, what if we use ANMs for equities? What would that do? Would that improve markets? So the hypothetical. There is no, in contrast, we normally do in economics, we do, positive analysis. We look at what's happened. This is not something that we have. We're just trying to see what would happen if we did. Okay. So this is some motivation here. So blockchain, as I see it, is a borderless technology, and it allows essentially the general purpose technology to value of management. The broadly as you can describe it, it's all about Right. So it's and so what DeFi is these are financial applications that run on the blockchain. And what they have done is that they brought some genuine new ideas. So for economists, I think this is very interesting because normally in Finland, we have institutions that have been there open for decades or even centuries. And it's very rare that something genuinely new comes. But automated market makers are actually a concept that I don't think there's a parallel in traditional finance. So,
very, very briefly. So traditional trading, and I'm going to show a contrast to a blockchain. He goes as follows: there's a buyer and a seller of a security. Now, they usually can't actually trade directly with one another. They have to go through a broker. The reason is actually by how the traditional infrastructure is actually set up. So there's actually no way around this. These brokers then have to go to a trading venue. It could be a stock exchange or some other mechanism. Now, what these venues are essentially just information processors. So they get messages. Messages are orders. They process these orders, and if a trade occurs, they send that information to a clearinghouse. And that clearinghouse then arranges the settlement of the transaction. So what that means is they have to go to the custodian banks of the brokerages and then inform them of a transfer having to occur. Now, since we've all seen the collapse of FTX and all that in the last half year or so, it's really important to understand what's going on here. So a broker is not a bank, right? A bank takes deposits and then they do essentially whatever they want with the money, right? They give you an IOU, which is an account entry. A broker actually takes an asset and it goes to their custodian bank. So there's a record of ownership attributed to a particular owner. This is a big problem in the crypto space because in the crypto space, a crypto exchange actually takes custody of the assets and they don't separate it out with the custodian. So if you see the discussion that happens, that openness is related to that. That's not relating to the paper, but it's just for your own information here. And anyway, so once the transfers happen, there has to be a change also in the records of beneficial ownership, because if the firms that the stock pertains to have information to send, they need to know to send it where. And of course, because there was a trade, the buyer has to pay the broker, so there's the payments network. that you have to use. Now, if you look at this is actually a simplification. This is a pretty complex system. If you look at the infrastructures that are needed, there are two for the brokers. There's the stock exchange, there's the clearinghouse, there's the custodian banks, the beneficiary ownership. There's also the cash custodianship of the cash amounts that are recorded with the brokerages, and there's the payments network. So these are an enormous number of infrastructures that have to be jerry-rigged together. This system has not changed in essentially 100 years. I mean, it's been a little bit more electronic, but if you have the idea that this is really fast and works on modern tech and all that, no, it doesn't. Some of the times in the clearinghouses, things actually literally still happens with paper and pencil and an Excel table. Yeah.
Can you give an example of a custodian? I'm having trouble understanding what exactly that is.
A custodian bank, usually this actually would be a bank, right? But in the crypto space, for instance, Gemini is a custodian. So they have to have special recognition from the regulators that they have the security requirements in order to serve as a custodian. Coinbase also has a custody service in the crypto space. Most of the major banks have custodian services, but they're separate from the other operations. So the really important part is that there's a record of ownership attributed to the particular owner. Okay, so now the reason is, of course, that you don't want the brokerage to take your funds and do whatever you want with them, right? Now, in some sense, the brokerage sometimes takes control of users' assets in the sense of that they lend them out to short sellers, but that only goes with the permission of the investor. Coinbase and Kraken, well, Coinbase in particular, had an announcement about a year ago where they said that if Coinbase were to go bankrupt, then because the assets are commingled, it's possible that the asset owners actually become creditors, junior creditors, which meant that they didn't properly account for where the money went. Anyway, so this is not really what I'm after. I just wanted to say this is an incredibly complex system. It's there for a particular reason, of course, because there's all these trust relationships that you have and all these black boxes, but it's not particularly efficient. Now, just to give you a difference and a view of the workflow. So again, when you have an investor goes to a broker goes to a trading venue, then it goes into the settlement infrastructure. That's usually the flow of how a trade works in the current world. In the crypto world, there's actually 3 different ways of how you can trade. So the first one is you can trade with the trading venue, say Coinbase and Binance. What you have to do is you have to transfer your assets to that venue. And these venues actually are not like exchanges, right, which only process information. They're actually more like, almost like a bank, because they take custody of assets. I mean, nowadays there's more of a requirement to separate it out, but in principle, that's what they do. So if you actually want to settle and be the ultimate owner, you actually have to transfer your assets out and put it back onto the blockchain into your self-custody wallet, right? The general rule is not your keys, not your assets. There's other versions of how you can trade. You can trade directly on the blockchain. So your sponsor here would be happy to see themselves here on the slides, where basically you do atomic swaps. And this is what I'm going to cover. And this is the interesting part of this paper. And there's a third version, which is where you can use what's referred to as a roll-up. A roll-up technology. So roll-up, generally speaking, just describes a situation where you take many transactions and you put them into one. Now that's very efficient in terms of throughput. So for instance, for the Ethereum blockchain, the estimate is roughly that these roll-ups can process the same amount of, in Ethereum, every transaction or everything that you do is measured in gas, which is computational cycles. You can process about 500 transactions for the price of one with a roll-up, more or less. Right? So in the best case scenario. So there, it is actually very similar in a way. It looks similar to using Coinbase and Binance because you have to transfer your assets into a smart contract. But the difference is that within a roll-up, nothing really happens that you don't have control over. Right? So any transaction there is cryptographically provable. And essentially, it's impossible for a roll-up organizer to cheat. So, I mean, I'm waving my hands a little bit around here, but the important part to see is this one here uses still the technology and the security of the blockchain, whereas here, as my wife put it nicely, there's always a laptop, right? So everything happens on the laptop. Here, everything is provable. Coinbase actually recently, just yesterday, announced that they are building a layer 2 solution, or they have built a layer 2 solution, which is similar to this roll-up idea, which is really quite something. Okay, so now to automated market makers. So how do automated market makers work? So they are actually quite an interesting concept. So the first question is why do we need an automated market maker, and how do we trade on a blockchain? Now, in principle, you can organize trading on a blockchain just as you do on a normal exchange, because you can take an order and you can write the order into a smart contract, register the smart contract on the blockchain, and then build an order book from these orders. But that's incredibly inefficient because each order has to be processed by each of the nodes. Everybody has to record it. In real markets, 95% of orders never trade. And actually, the registration of the order already costs you a fee. So it's expensive, inefficient, really bad idea. Now, there were implementations early on to do this. There's a system called EtherDelta, but that never really took off because everything worked fine when blockchain was underused, but once it was used, it's just not possible to run it. So along came automated market makers. And here's how this works. Essentially, an automated market maker creates a liquidity pool. Now, pool means there's a big pot in the middle of the room, and then lots of people deposit pairs of assets in there. So for instance, if you want to trade Ethereum against a stablecoin US dollar, you deposit both of these assets in there. And then somebody wants to trade, goes to that pool, he throws one type of coin in there, and then gets an exchange rate for the number of coins that he gets to take out. All of that then happens in a atomic swap. So basically the money leaves the owner's wallet and goes back into the wallet. So the other coin goes back into the wallet, and that's it. As a process for the user, it's extremely easy to use, although there's a huge learning curve, but it's quite straightforward. And the interesting part is that, the deposits that people are made, everything is prorated. So any fees that are created, because this guy, he has to pay fees, those fees are distributed prorated. The risk is therefore prorated, and so on and so forth, right? So and now why is that different? It's very different to modern markets, because in modern markets, and I'll come to that in more detail, but say if you take a normal equity market, there are also liquidity providers, but these liquidity providers, liquidity provision is very, very expensive to do, not because of the capital, but because of the technology. Because you need to worry that so as a liquidity provider, what you want to do, you want to provide liquidity when it's opportune, so when it's good for you, right? So that means that you need to monitor markets constantly, which is very, very expensive to do. In terms of technology, you need really high-speed data lines. You need also pay for data everywhere from every exchange. You need to monitor every single movement in market. So that's really quite difficult to do. And for that reason, there's now a few very large firms that employ, hundreds of people, computer scientists, also economists, that basically spend all their time trying to think of when is it right for us to provide liquidity. Here, this system as such is actually set up so that there's no benefit of being fast, right? So everything is shared anyway. So in many ways, this is a much simpler solution to liquidity provision. Right? If you think about it, if you were to provide liquidity as a liquidity provider, there is no advantage for you to being fast here, because there's nothing really that you could do that would help you by being faster, because everything is already shared. So there's less to earn, but there's also less risk. So, yeah, sure, go ahead.
It's also the case in version 3.
In what?
In version 3.
Yes, definitely. So the difference, okay, so this is so in case you don't know, I'll come to explain a little, let me actually postpone that, because I'm going to explain first the pricing function in version 1 or version 2, and then I can say a little bit about version 3. And actually, there's a very subtle thing where it's actually quite relevant. It's the use of capital, actually. So just briefly here, this is shows you a little bit about the volumes that are processed by these automated market makers. A lot of money, of course, in terms of the real finance world. This is really nothing. It's like a rounding error, but considering, however, so these markets are used obviously by retail traders, and so retail traders account for maybe 10% of trading volume in equity markets. So the retail trading volume of crypto markets actually exceeds that of equity markets in terms of dollar volume worldwide. And so if you look at the fraction of trading So this is the fraction of DEX trading to centralized trading. At some point was like 10–15%. That's quite a lot. In particular because, I mean, I say it's very easy to use in AMM, but actually it's not that easy to use because you actually need to first get the crypto assets, you need to move them, you need to understand how self-custody wallet works, you need to understand, you know, every time you want to have a trade, you actually need to have the Ethereum tokens in your pocket because otherwise you can't, you know, operate and access them because you have to pay for the usage of the network, the gas, right? So it's actually quite a learning curve. It's not easy to use. So considering that, this is actually pretty remarkable, I would say. Now I'm saying this because anybody, you know, later on says, well, why, you know, why would you want to apply this to equities if it only counts for 10% of markets for crypto, right? So here's a thing that here's a few things, and I come to this now. So the key feature of an AMM, in my opinion, from an economics perspective, is the pooling of liquidity, which is interesting, the prorated feature of fee income and risk. And so for liquidity demanders, it's convenient because there's a predictable price that's important for particular types of operations. So you put money in, you know what you're going to get out, more or less. It allows continuous trading. So this is different from auctions. So auctions are very rarely continuous unless you think of a limit order book, normal market, as a continuous auction. Here you really have a large amount of liquidity available in continuous time, and you have ample liquidity. So there's a lot of liquidity usually in there. For liquidity providers, here's the interesting part. You can actually use the existing assets to earn a passive income. So that's different from how we normally think of liquidity providers. So normal liquidity providers or market makers usually try to do not own the asset. They don't want to own the asset. They're just there to intermediate in the very, very short run. These ones are actually set up in such a way that if you own the asset, you can put it into an AMM, become a liquidity provider, and earn extra income based on it. It has a risk, it has a cost, but also has a benefit. I'm going to spell that out in detail. So the question that we have is, can you build an economically viable AMM for current equity markets? Is that actually even possible? Right? And that's not an obvious question because markets are actually, in some assets, very cheap. And it's not clear that an AMM, given how they're structured, could actually compete. And so then the question is, would that actually lead to any kind of improvement? So the answers that we have is, yes, you can do it, and you can actually improve it massively. So when you look at current data, across the board, across all kinds of assets, you usually can save up to 30% of transactions cost. That's now, you know, you tell me if you find this credible, but it's a massive amount if it's possible. I mean, it's a very enthusiastic, optimistic view on the one hand. On the other hand, some of the things that we do, we don't take into account the question of, if this is something that people like, would you have maybe more volume? So that was something we don't actually look at. We just take everything as is. Now, it's also important to know that although AMMs run on blockchain, that nothing says that you have to run it that way. You can take the existing infrastructure and build an AMM. Right? It's not required that it works on the blockchain. Now, there are reasons why that actually would, if you want to create one, I think it works better on the blockchain because competitive reasons, institutional reasons, and other barriers that are there. But in principle, you can build them just on a laptop if you wanted to. Okay, so that's that. Any questions for now? Right, so now I'm going to come to the details of an AMM. So I know you've seen this before, probably. I'm still going to run through this, okay? So the most common form of an automated market maker is, and I actually didn't say that, but so one of the key questions that you should have is when you put the money into the pot and you want to demand one of the coins, what is the exchange rate that you're going to get? What's the price if you want? Now, there's multiple versions, and if you look at the literature, people usually describe that there's all kinds of functions that you could have, but in reality, there's only one that's used, and that's the constant product rule. Okay, so now what is that actually? So we start with there are A units of the asset and C units of cash that people have deposited. Okay, now they're deposited at a marginal price. The marginal price is just the ratio of cash to assets, right? So you have like $1 million in there and you put 100,000 shares in there, the marginal price is $10. So that's, if you wanted to have an infinitesimal quantity, that's what you have to pay. Now, the principle of an AMM is that you take an asset out, you have to put another asset back in, And there is a so-called liquidity invariance rule. So that means that if you, for instance, want to purchase Q units of the assets, you have to pay a price delta, so it's the change in the cash into the pool, so to extract these shares. And it has to be the case that the liquidity before, measured by some function, is the same as liquidity after. So there's Q units have left the pool and delta C units have been added to the pool. And constant product basically just means that the product of the quantities have to be the same. Now, if you look at this carefully, in principle, it actually just looks like a Cobb-Douglas function, right? It actually is a Cobb-Douglas function with the exponent being 1. So here's an example of how this would look like. You have a liquidity. So each of these, the product of something of an initial deposit defines an isoliquidity curve. So if you want to purchase a quantity Q, you have to pay a price C of Q up here. You have to put an extra amount of cash in here, which is measured by this amount here, there, so that you stay on the same curve. And that's really all that how it goes. So now that's the functional form which is used for any AMM that I know of. Now Nir has asked me what happens with V3. The key difference between the version 2 in Uniswap and version 3, by the way, version 1 was, I think, was only Uniswap token against the Ethereum token, so it's a very limited amount. Version 2 was the big one where you can trade any token that you wanted. So the difference between version 2 and 3, there's a number of differences. The key difference is that you can specify as a liquidity provider that you're providing liquidity only in an interval for the prices or exchange rates. And so the difference there is basically, as long as the price is within that interval, this curve applies for you, right? You're basically playing along this curve. And if the price exits that range, then you don't trade at all anymore. Your coins that you've deposited are not available for liquidity provision. That's really the difference there, right? There's some other differences, which is you can pick different fees. So there's fee tiers that you can choose. That makes it a little more complicated, but the principle is always the same, right? So the constant product still applies there. Yeah, I'll come back to that because it's actually an important point when it comes to the usage of capital. Actually, maybe I should just say this now, right? So the issue is when you have the entire curve, you make a deposit. In principle, you standing there to, no matter where the price moves, you're providing liquidity, right? That could be potentially very, very expensive, right? So if the price drops all the way, you know, if you have an asset, the price of the assets drops close to 0, right? Then, you know, people will put a lot of this asset in and they're going to extract all the cash. Right, you have an asset essentially is worth 0 and you've extracted all the cash. So that's not very pleasant. So you would need a lot of capital to service the entire curve. In reality, in equity markets, for instance, that's never the case. In equity markets, we have what's called circuit breakers. So if the price of an asset goes up by more than 10% over a short period of time, I'm not sure exactly how it's measured, but let's say go with the day. If it goes up or down by more than 10%, markets stop. And then there's a reset. And here, this would mean the following is that the amount of cash available and assets available for trading doesn't actually have to be the entire amount. It's only to service the drops of 10% that's necessary. Okay? Now, this is important because assets or cash in particular is expensive. You need to borrow it in order to supply it. Okay.
My question is about the passive income. So if you need to monitor for the range when you're providing version 3, so like it's harder for like you need to be more active, you need to update your.
Correct. Yes. Okay. So fair enough. So if you're going with a particular range and you pick a tight range, I mean, as long as it's in that range, you don't have to do anything. But if you want to monitor what the right range is, then yes, you actually have to look after that. That's correct. Yes. So when I say you don't have to monitor the market at all, that's obviously not true because you actually do have to monitor it. You may actually want to extract your liquidity also when the prices are moving too fast, when you don't feel comfortable anymore. So there's obviously a lot of that. So the way we do this here is, in particular, if you think in crypto markets, prices often swing quite wildly. And so this is a concern. In stock markets, that's not necessarily the case. Again, circuit breakers are there, so that help. And to some degree, you can mitigate this also by technological rules. I'll come to that because that's actually part of what we thought about too. Okay, so just very briefly, so from this function, we can compute the total cost of trading. If you want to trade a quantity Q, you have to pay delta Q. This is given by this function here. The price per unit is obviously you divide this number by Q, and then you can also compute, well, the average spread paid. So I call this word average spread here. It's essentially, it means what's the difference between the starting price and the price that you've actually paid. In normal traditional markets, that's the effective spread. And the equivalent here is this number here. Usually it's referred to as the price impact in the crypto world, but the price impact you could also say is like when you make a trade, it's the end price, the marginal price that exists, and not, but this one here is the what you actually pay. So the effective spread, this is the analog here. Okay, and just gives you here a view of the pricing function. As you add more liquidity, this curve gets flatter, so the price impact or the average spread that you pay gets smaller. So it just behaves as you would imagine it would. Okay, so now we have to think about how would we use this and how do people react? Now, the first question is you'd have to look at liquidity providers, right? What do liquidity providers get out of this? And how do we measure even the risks that they face? Now, I don't have an economic model in the sense of there's an agent who has a utility function and then tries to maximize the utility function. If you need one, think about it just somebody who's actually risk neutral and is willing to provide liquidity as long as they have a positive payoff, right? It's very, very simple. So what I'm trying to do is I'm trying to try to express everything here just in terms of the price function, right? Without having a utility function that messes around with things. So taking a step back though, if you're a liquidity provider, right? The basic idea of a liquidity provider is you will lose money on some trades and you gain money on other trades. Now, the trades that you gain money on are usually what's called the balanced order flow. It's the part where buy and sell orders are the same. In a normal market, what you do as a liquidity provider, you earn the bid-ask spread on each of these trades. So for all balanced trades, you're making money. But there's also trades that move the price, right? It could be for a variety of reasons. It could be that there's a change in the underlying, could be asymmetric information. I'm agnostic to this here. The only part I'm saying is that there are a certain number of trades. Whenever there's an imbalance, the price moves and you're losing on that. Okay. Now you're losing on that because you say, you know, at the end point, so say you take a trading day, during the end of the trading day, you say, believe in efficient markets, so the price is the truth. If there is, so the price that is the imbalance part moves the price from some level, say P0 to level PT, and that's basically your loss. But you gain money in terms of the bid-ask spread and all the balanced order flow. Okay, so there's a lot of talk here, but you know, really the idea is that you make money as a fee income, right? Then after the trades, you know, when I make my assessment, there's a time P1 where the price moves from P0 to P1. On the imbalance, I lost. So this is the value of what I sold something at. This is the revenue that I created, right? So this is my net loss or benefit, and that has to be less than what I earn in terms of the fee income, right? Because this is what I sold that is actually worth what I actually would have lost. Okay, so you know, if we go with that and describe this here in very general terms, I'm waving my hands a little bit, so there's a lot of underlying assumptions, but actually I have a point here. So the fee income in an AMM, there's a fixed fee set that you earn on each trade. The price P1 is just the price that is there at the end of the trading day. B minus S is the net quantity. This is the quantity, if you want, the part of the order flow that moves the price. And then there is the revenue. By the way, it should not be B minus S, it should be B plus S, because it's the volume, right? So this is the trading volume. So this is basically the cash amount that you get. Okay, and so we can all quantify this, right? So there's V is the total volume of the trading day. P1 minus Q is P1 times Q is what the price moving quantity is worth. Delta C of Q is the cash income that I get. So the assumption is that the balanced order flow, and so this is actually comes from this pricing function. If the orders are perfectly balanced, then the cash inflow and cash outflow just exactly cancel out. So you don't actually earn any income on that. It's different from when you have a bid-ask spread, because you earn the bid-ask spread multiple times over. So here, because of the liquidity invariance, if somebody buys B units and sells B units, then the net cash that you receive for this is 0. All right. Anyway, so this equation here has to hold. We can compute what this delta C is, and then we can go and determine what my loss is. So here's how it goes. So this quantity, suppose you have a price movement. Now, so I should put it, if I want to apply this to data, what I have is price data. I have a price data at the beginning of the day, I have price data at the end of the day. I can compute the price movement. And I can also determine, so this is something which I observe from data, and I can then determine if I had an AMM, what would be the quantity, the imbalance that would have caused that price movement from happening, right? So that's basically what I'm trying to extract. So I can compute that quantity using this pricing formulation, right? And so this amount Q star that moves the price from a value P0 to value P1, taking both of these as given, is this amount here. Now I can reformulate it as follows. The cash amount that I have to put in, right, and the asset amount have exactly the same value at the beginning of the trading day, right? Because remember early on, P0 is C over A, right? So I can substitute this out. And then P0 over P1 is the same as 1 over the rate of return, right? So therefore, I can then write this quantity as the initial deposit in assets and the return, given that I know what P1 and P0 is. Now, the liquidity providers must make a non-negative expected return. I want to now express everything in terms of returns so that I don't actually have to worry about the deposit. Okay, so therefore, it needs to be the case that the price movement loss plus the fee income must be divided over the value of the deposit has to be non-negative. Okay, so now I can actually express this because I have a look at the price movement loss, right? Divided by the value of the deposit. So I divide the value of the deposit is P0 times the twice the amount of the assets times the price, or twice the amount of cash. I can express that actually, and it's again, it's just a function of the returns, right? So it's the square root of the return minus 1/2 times that. And you're going to see that, by the way, the same formula from Andrea Bourbon and Angelo and so on and so forth, Rinaldo. Actually, I saw that in their paper. So this is not my analysis. They actually, I've seen it there, although I think I explained it better. So I call this the implicit loss from long run adverse selection. Right? So it's a little bit of it's a bit of a mouthful, but the idea here is that you lose money because you have, because you keep your funds in an AMM. In the DeFi world, this is also referred to as the impermanent loss. I find that term unsatisfying, right? Because implicitly, it is actually a permanent loss, right? Because prices have moved. So this is basically a result of what we refer to as a permanent price impact. And a permanent price impact is, something that is costly to you, right? So the DeFi world calls it impermanent loss because they have this idea that all prices are just mean reverting. And because they're mean reverting, you're just leaving, you're basically trading out of a position at an inopportune moment in time. But from an economic perspective, that's a poor choice of words. Okay, right? And so this is, by the way, how this function looks like. The important thing here to note is that as a liquidity provider, you lose whether or not the prices go up or down, right? Because if the prices go up, people are going to buy from you an undervalued asset and give you cash for it. If the prices go down, they're selling to you an overvalued asset and take your cash. So you lose either way. Now, that's not a problem, right? It's just a fact of liquidity provision. You just need to earn more in the fees to accommodate for this loss that you have. All right, now the second term is the fee income, by the way, which I can also express in relative terms. So the fee income is F multiplied with the total volume, and you divide this by twice the market cap, by price of deposit. Now, if I want to apply this to stocks, the right way to measure this is in terms of the shares outstanding or the market cap, right? Market cap is shares outstanding times price. So that's the shares is A, and shares times price is the market cap, right? And so the right way to do it again is to express it as a share of the market cap, because if you think about the liquidity that can be provided for an AMM, the maximum is all shares in existence, right? So, and then that actually raises the question of whether or not there's actually ever enough liquidity, for instance, available relative to the market cap that's out there. So now, if I put everything together, so I have the amount that I lose, it's ILRAS or impermanent loss, and I have my fee income. And now the way we think about this as there's a maximum amount of liquidity that you can provide to break even. So here's how this works. So this term has nothing to do with liquidity provision. It is what it is. The fee income actually declines as you put more liquidity in the pool. Why? Well, because intuitively you have to share it with more people. Right? The same amount of volume, but you get then the same amount of fee income has to be shared with more. So as you put more liquidity in, your income declines. Now, if you very loosely, if I wave my hands and if I wave them more, I'll probably take off. But the basic idea is that you deposit in an AMM and you deposit as a liquidity provider, you compete for the deposit. So as long as there's something to be gained, you put more liquidity in. You put liquidity in up to the point where you're breaking even on expectation. Okay. So therefore, we can define a value, alpha bar, which is the largest amount of deposits, such that the liquidity providers will break even.
But how do you account to the fact that maybe more liquidity will generate more demand?
Not at all. No, I don't account for that actually. So, but it's a very good question, because that's actually that's a really important question actually to figure out. I mean, so what is the elasticity basically of liquidity demand given that the cost goes down? That's a very good question. I don't actually look at that. I would argue that the way, if I could find a way how this can be made profitably in the sense of that it's cheaper than current markets, then whatever I find would strengthen the results. So I can't. So the way I set it up, actually, there's never a situation where you could lose or could be worse off. But you're absolutely right. It could go the other way. There is a paper, by the way, which I will probably say in the next slide, it's by Fahad Saleh and Joel Hasbrook and Thomas Riviera. They have actually a model of the whole thing, and then they actually try to determine also what is happening. Sometimes a higher fee could actually lead to more volume. Right? I'll come to that too, actually, in a second. Anyway, so I can compute this. I can actually describe this in closed form. This is obviously knowing what the rate of return R is. Okay, so anyway, it exists, it always exists, it's always there. You can always define this. Now let's take the perspective of, there's actually questions. Should I actually address the questions? Huh?
Well, more about the new
Yeah, okay, good. All right, okay, good. Okay, so now let's talk about the liquidity demander for a second. A liquidity demander, say there's a liquidity demander wants to trade a particular quantity. Right? Now, when would this person want to pick the AMM? Well, they have two choices, right? They have, let's say, you compare the existing market to an AMM. In the existing market, for their quantity, they have to pay the bid-ask spread. Right? In the AMM, they have to face a price impact or again, a bid-ask spread if you want, and they have to pay a fee. Okay. So now we can define, so this is a much simpler problem, but you can define a lower bound alpha bar. This would be a function of the quantity Q, and I'll have to explain a little bit of what that actually means. But you can find a lower bar such that the AMM would be cheaper than the limit order book where you pay the bid-ask spread, taking that as given. Okay. And now for any alpha that is larger than this alpha lower bar, so any more larger amount of liquidity provided, the liquidity demander would actually prefer the AMM. So this one again can be expressed in closed form. And so then whenever the upper bar, so that's the liquidity bar bound, exceeds the lower bound that the liquidity demanders need, then an AMM could be economically viable. Now, it's not clear, by the way, that this lower bar, alpha bar, actually exists. Right? This could be 1 or could be above 1. Right? So it's possible that the traditional market would always be cheaper, such as it is. But if it isn't, then we're good. Also, this amount here, so this is in relative terms in basis points, or if you want a percentage of trades, this is the largest amount that will be possible in terms of transactions cost savings. And the way I'm going to examine the economic benefit of an AMM is as follows. I'm looking at a situation where we set the bound for liquidity provision at the alpha upper bar. So that's the largest amount that is available. So liquidity providers will break even. And then I can measure all the benefits just by looking up what the liquidity demanders would be making. Now, one thing to note here is, so the very loose idea again is the liquidity demanders, suppliers, providers, provide as much liquidity until they break even, and then trading starts, and then we can see what the liquidity demanders make. Okay. Now here's if you want, you can have a fractional contemporaneous liquidity benefit that you get from an AMM, and that function here actually has a maximum in terms of the fee that is being paid. So this is a function which actually is not decreasing or increasing fees, but there's actually a local maximum. So it means that there is an optimal fee level that maximizes the benefits to liquidity providers. Why is that? Well, obviously, liquidity provider demander loses for higher fees because they have to pay more, but the liquidity supplier is also willing to provide more liquidity if the fee is higher. Okay, so you can actually find an optimum here. This is in very loose terms, and they do it differently. They have a whole model of optimization and all that, but this is essentially the same thing as what Joel and Thomas and Fahad find in their paper, right? So there is an optimum amount. Sometimes a higher fee can actually benefit a liquidity demander. And yeah, anyway, so now here's how, so this is just a bunch of formula, right? So this is just tells you what is there, and now I'm going to take some data and trying to see, okay, so what would that actually mean in practice? Now we have a few things we have to discuss here, because there's a quantity Q, right, which is obviously different for every trade. There's there's also a question of, for instance, the return. How do I assess the return? I've actually written the whole thing with known returns. You can actually write this also with expected returns. There's I've not the way I write. I mean, it's something in an appendix, but it can be written as just an additional term. So how would we think about how would this be implemented in practice for equities? So the way I think about it as follows. One of the things that we know from standard markets is that we close them, right? For good reason, because firms have to make announcements, and these announcements should not affect the trading process, right? Why? Well, because when you make an announcement, you actually can create adverse selection, because some people will be faster in terms of reacting to that information. So the common process is when new information comes along, you have an auction where speed is not an advantage, right? So that's why one of the reasons why we keep markets closed. So the idea is markets are closed overnight, then the market will start with an opening auction. It has nothing to do with an AMM, but what that does, it determines the starting price, P0, right? So that's the price at which everybody then makes their deposits. Now, there is a fixed fee. The fee is announced ahead of time. There's a particular ratio. People then compete so that the liquidity provision will reach this level alpha bar. Then the liquidity is locked for the entire trading day. So there's no way how you can withdraw it, just for simplicity, right? And then at the end of the day, the remaining deposit, all the deposits that are there are going to be released to the liquidity providers, and then the market closes. Everything gets sent back to the liquidity provider, and then next day everything starts again. So that's a process. So why is this? What does this do for you? So first of all, it allows me. So the liquidity provision will be there. It's stable. Then it allows me to determine exactly what the loss would have been, because I can look at the post-open to pre-close return, right? I can see what the volume is, and then I can make any number of other assessments what happened there. The assumption that I'm making here is that in the empirical investigation is that liquidity providers act backward-looking, right? So they submit their liquidity today by looking at yesterday's dollar volume, the fees that were there, and the returns that were there. So they're taking these returns from yesterday as these will be the returns for today. Now, ideally, you want to have a computation of expected returns and a distribution and all that. Yeah, sure. But, sure, let's do that too. You can make it any number, any way more complicated as you want. This is just basically an eyeballing there. And you provide liquidity also only if you actually would be making, if actually there's also liquidity demand. So it's actually feasible for liquidity providers, demanders to come to you and trade with you. So here's a few peeks at the data. 12 minutes. Okay. So we use, just existing data. We use CRISP. This is the standard database for finance for the shares outstanding. Wards has a computed statistics for quoted spreads, volume, open to close returns, trade size, VWAPs, and all that, right? We take the time horizon from 2014 to March 2022. This is the data. This is the end of the data that we had. We exclude what's called the tick pilot. I'm not sure if you know it. It's a little thing where the SEC had this grandiose ideas that if you increase the tick sizes, that somehow this will make markets better. In December, they go the other way. They say, no, we have to decrease tick sizes because then markets get really much better. Whatever. Here, this would just distort the results, right? So we exclude that entirely. We look at all common stocks, for instance, so no ETFs, for instance. That's because ETFs liquidity is actually not given by bid-ask spreads. So that means about 7,500 securities. We don't cut by price and size. For people who market microstructure, it would be important because you normally do that. We don't explicitly want to do it. We take everything. And any numbers where there could be no bound, we actually winzerize because sometimes numbers could get close to zero and then everything is low. And then we do the plots that you see here in the next few pages will be yearly averages per stock. So it's a lot of dots, right? So around 50,000 dots. So that's what you see. Okay, so the first thing is some things that we have to look at when we compute this is what volume should we use as the right benchmark? Okay, because that's actually quite tricky. So what we do is, so first of all, some volume, actually quite a lot of volume is intermediated. So there's a market maker, the market maker goes in and they trade on both sides of a trade, okay? When you have an AMM, there will be no need for intermediation. So volume should actually drop. Now, if every single trade is intermediated, that means that half of the volume would go away. Right? So therefore, what we're using the volume divided by factor 2. I personally think that's probably an overestimation, but it's a good benchmark. So if we can do everything with volume divided by 2, that seems fine, right? The next question is, what's the right queue? What's the right order size? So this is where it gets a little iffy. So you can compute what the average order size in a day is, but I don't have a distribution. I would have to actually go through the tick by tick data and then determine the distribution. And the trades are basically the computation is based on the average order size. Now, the average trade is actually usually, so 80% of all trades usually are just for 100 or 200 shares. So that's just a fact, right? Because a lot of trades are split up into smaller units and then there's very large trades and it's a bit of a mess. So what we went with is very simple. We took the long run average, we take the variation of this long run average and we add 2 standard deviations to the trade size. So the long run average is roughly, let's say 300 shares. So that includes some very large shares of 400. And so then we have 2 standard deviations, adds another 100 or 200 shares. Okay. All right. So here, just to get a little bit of a sense, in case you're not familiar with trading data, on the horizontal axis, I will measure everything from now on when the log market cap. Volume is increasing in size, right? So larger firms trade more. Quoted spreads are decreasing in firm size. So smaller firms have much larger quoted spreads. Retail trading, there's actually a way to measure retail trading, is much higher as a percentage of trading for low volume stocks or smaller stocks. And that's because here there's a lot of professionals trading, whereas there's very little professionals here. And then this gives you a sense of the feasibility threshold. So what you see here is an animated figure. We increase the fee from 1 basis points to 30 basis points. And we're looking at the difference of the liquidity provision bound for liquidity providers to break even and the minimum bound that liquidity demanders require in order to be willing to trade. What you see here is that as the fee, you see that they're very large stocks. They need, when the fee is increasing, it's no longer feasible for them to trade. That's because for liquidity providers, it is these stocks trade at very low bid-ask spreads. So if the fee is too high, you simply can't make it profitably. But what this basically shows you is a little bit of a picture of, gives you a sense that as for smaller stocks, you probably need higher fees in order to be economically viable. And for large stocks, you need lower fees to be economically viable. Okay, now this figure gives you the number of days in the sample for which the AMMs are better given a certain level of the fee. So what you see is that as the fee increases, the percentage of days is declining, obviously, for the large firms. And actually it is increasing. This is a little bit, looks like the rain goes up, right? So it increases for the firms that have a lower market cap. And then the last one here is if you look at the benefits that in dollar terms that are possible per stock, you can see as the fee increases, the benefits as a whole actually go down. And that's because the large firms that we have here, there's much more trading volume. So there's more to be gained in dollar terms. Okay, so that just gives you a peek at the data of how it generally behaves. And now I'm going to do one step further, and we're going to go with the optimally designed AMM. So optimally means here is that we take the fee that maximizes the surplus for liquidity providers. Right? So it's given by this formula here. The way we implement it is, again, it depends on this quantity Q. We take this average quantity as we compute it, and we do set the fee based on the previous day's data, right? So on the previous day data, we know the volume, we know the size, we know what else we know with the return and all that. So we can determine all of these different numbers. And that allows me then to determine what the right fee would be. Yes.
The fee will be stock specific? Or?
Yes, that's right. So here you actually have the picture of that. So every stock would have a different fee and it would be permanently updated. So this gives you just the average. And as you can see, this is, the plots sort of gave the indication of how this would look like, right? So that small stocks would have very high fees and large stock would have very, very low fees. I have a table which I'm going to show just to get a sense of it. But for the small stocks, for the smallest decile, it's roughly 30 basis points. And for the largest decile, it's roughly 0.7 basis points, right? But there is a fee that's available. And now if you look at for those days, so the first question is, how much do we need to deposit in terms of the market cap of a stock? One thing I want to point out, there's this group of firms here. It's kind of, there's a blob of data here. You will see this in the other figures too. This is a number of about 200 very low volume stocks. So they have actually only about 20% of the volume of all stocks in the same decile of, or in the same range of market cap. Okay, so these are little weird stocks in some way. But what you see here is in terms of market cap that needs to be deposited is somewhere on the order, if you ignore this one, somewhere between 10 to very close to 3%. Right? So it goes down for larger stocks. So it gives you in a sense of the capital requirements, right? The days that the AMMs are better for the optimal fee, you can see is somewhere on the order of 85%. So most of this is up here. And then you have these low volume stocks here that are sort of messing with my data a little bit. Okay, so now if you look at the transactions that you save, so this is the basis points of transactions that you can save by using an AMM. It's for low stocks, it's actually pretty substantial. It's several hundred basis points, so it's 150 basis points on average. It's less for the large stocks, right? Because they're already, everything is very, very tight and costs are quite low. But you can see in particular for small stocks, there's a huge change here. Now, this is conceptually important because to me personally, so I think one of the biggest challenges that markets face is small stocks don't trade a lot, right? So that's a huge problem for the firms themselves. Being public is extremely expensive. You have all these SEC regulations that you have to buy listing requirements and all that. And oftentimes you don't get the benefit of the public market because nobody wants to trade your stock. And it's sort of like it's a chicken and egg problem, right? So institutional investors are not willing to buy small firms because there's, they can't offload their position. There's no liquidity when they have to do it. So that's why the retail fraction is so high in these stocks. And, it just you can never get out of that loop, right? So, here you can see that you can actually save a lot on trading costs. And so to your earlier question, you could imagine that actually could substantially increase the amount of volume because it could be pent up trading demand that could be satisfied. Okay, so here is the relative savings. So you take the AMM fees relative to the bid-ask spread. So that's about a savings here. This is why I came up early on with an average of 30%. So the average amount here, this is the average amount that you save relative to what is already there. And then this gives you a little bit of gives you a sense of the dollar amount that can be saved by running an AMM. Again, For large firms, it's larger because there's just more volume. It's small savings that you make, but for many, many trades. So there's a lot to be saved here. Okay. Also, you may want to ask what is actually happening to liquidity providers. You see that on average, liquidity providers here break even. Right? So this is in basis points. So the average number is like minus 0.15 basis points. That's statistically insignificant. So actually, the way I designed it empirically actually works also in practice. And then, yeah, I skip over that. So some numbers here, just so you see it. Let's start here. Hold on. So the average optimal fee, right, in basis points, this is here by year, and this is by quintile, right? So it goes from the smallest stocks about 31 basis points to the largest pop is about 0.8 basis points. The days that they're better is across the board is somewhere between mid-70s to 90% of trading days. So this is when the AMMs actually dominate. I can skip over that. Average savings, you can see, is small for small firms, of course, because there's trading, and large for large firms. And then if you look at the aggregate savings that happen over the sample horizon, I mean, if you really want to be going with numbers, so this is 2021 was a full year of data with very high volume. You would save roughly $15 billion in transactions costs, right, of a total of $46 billion. And this is an eyeballed number because it's like, you know, it's like trading volume in dollars multiplied with bid-ask spreads. Right? So that's the cost here. So across the board, the savings are roughly 30%. Okay, I have another 2 minutes, right? So I'm just gonna conclude, but very briefly. So why is this relevant in the bigger picture? So the SEC actually in December, I'm not sure if you noticed this, but the SEC made a big proposal of, you know, changing markets, and they actually want to mandate how trading has to work in for certain types of orders and all that, which is insane. But so they basically say that you can save, you know, their method would save in retail investors $1.5 billion of trading a year. Now, this number to me is nuts, because if you look at the trading costs, you know, just eyeballing it for retail investors is at most $1.8 billion. So it's almost like it means that, you know, retail investors would not have to pay transactions costs. I can't fathom that that could possibly work. I don't understand how they came up with this. This is really magic, right? Whereas here, the origin of the savings is not magical, right? It's very simply two things. Number one, it's better risk sharing, even though I don't have a risk model there, but there is risk sharing going on. And secondly, it's that you actually use idle capital. So you use the shares that are otherwise sitting idly at brokerages, you put them into an AMM and put them to work. So that actually is a huge difference. So now when you take a step back, banks worry about any dollar that you put in deposit, they want to put to work right away, right? They want to give out a loan. That's the whole point about what a bank does, right? But for brokerage, it doesn't work that way, because you just take the deposit and the money just sits somewhere. So this actually gives people an opportunity to use that idle capital and make money off of it. So, you know, would this actually happen? I don't think so, because, you know, exchanges can't do it, right? Formally, they don't actually manage deposits, right? And they actually would lose, you know, their biggest customers are actually liquidity providers, right? So they would, and those are irrelevant here, so I can't see doing them, and they would lose all their data income. Brokers also probably wouldn't do it because they can't make money off securities lending anymore. And, you know, there's also a question of the trading fee income that would change this way, right? Because, you know, where would that come from? Would the SEC allow it? I doubt it, right? Because then the first thing they're going to say is, well, you make an AMM deposit, that's a security. So then every day you have to make a new prospectus. This is just regulatory perspective not possible to do. It's not clear what disclosures you have to make and all that. And then it's also hard to fit this actually into the current market regulation. Right? So these are all the downsides here. Now, I hope, however, if my numbers make sense to you, that this makes sense to actually do. Right? It actually would be a net benefit for markets as a whole. So going back to slide 2, blockchain is not technologically needed to run an AMM, but it seems to be, it's actually the way to do it. Right? So if you actually have tokenization of stocks, if you allow people to have access to the assets themselves, then you can actually have a tool like this one. So again, the blockchain actually here is not necessary, but it would actually be probably the catalyst to make it happen. Okay, I think I should stop. My summary is already what you've seen, right? So that's quite a lot of money that can possibly be saved here. Okay, thank you.